start, but a good market breadth. That I think really has been the hallmark for the market per se, that we are starting flat, but if the bias is positive, I think that is something what markets would respect. We consolidate here for next couple of days, markets would say, okay, that's good news. BPCL and oil derivatives, that's the top story. So Asian Paints, Indigo, HPCL, BPCL, that becomes oil derivative story. PI Industries making a comeback after a lot of, it has made a comeback 2%. Okay, now let's look at metals. JSPL, Jindal, JSW, JSPL, Jindal Stainless, that space, especially the steel pack, has been quite active and quite resilient of late. So that also looking quite interesting. So in terms of the market breadth, in terms of the newsmakers, reaction to PI Industries, some reaction to oil marketing companies. You want to look at SpiceJet and Indigo just to establish that the real impact of oil and crude is that getting captured there. Visha?
Yeah, it is. SpiceJet holding up 3.25%. Interglobe Aviation as well will just come off you on your screens. 2% higher for there. So clearly bumping up in trade. But at an index level, it's pretty quiet out there. Let's just revisit the newsmakers that we just flagged off. ITC after their analyst meet. Given that they've revealed their next growth strategy, retained the margin improvement guidance. Axis after that block deal as well. Indian Bank after the QIP, which is in the works. SRL. Pilpa Medicare, Z Entertainment as well. All these stocks would be under focus. ONGC Oil India, what are they up to? Brent has now fallen below $74 to a barrel, and that should not really augur well for ONGC and Oil India. Both those stocks under pressure as we speak right now. Laurus Labs, by the way, the news came in just last evening that US FDA has issued 5 observations for one of their arms at their Visakhapatnam unit. So look out for what that stock as well is doing. Titagarh Rail, again, a 75 lakh QIP of shares, that is, at almost 4.42% actually, to be precise, discount to its current market price. 994 is where that stock is. 933 is the QIP pricing. There's All Cargo, where in the November total volumes have seen a downtick on a sequential basis of about almost 12%. So a bunch of these stocks in focus. Kunal, once again in consolidation mode for the index. Stock specific ideas that you may have?
So I'll go with the private sector banking name. That's HDFC Bank. The stock seems to be drifting about at the 1650 odd mark. So I think looks attractive for the stock over the near term. And I think closer to 16, 20, 25 could be a good level in case if the stock dips to that kind of a zone.
Right. Shivangi, what about the trades that you're punching in right now?
Morning opening trade, I'm looking at CanBank. This stock is quite strong, and we've seen that it has held on to its 50 exponential moving average on the daily frame. A clear outperformance can be seen from the last 2 months. Follow-up buying can be seen after the breakout as well. So stock is quite resilient, strongly holding at higher zones despite the softness of the market. So recommending a buy here with an immediate target of 460 odd levels, and 435 would be a crucial support to watch out for.
Samit Vartak joins us, and let's take our conversation forward. Samit, nice to have you back. It's been a while, we've not interacted. How you been? How things?
Absolutely, my pleasure, Nikunj. Yes, it's been a while. It's been, I think, probably a year since I interacted with you. But absolutely a pleasure to be here.
My friend, I can notice that you're graying. Is market में क्या stress है?
Stress यहाँ पे stress coming down.
It's been a good year for every asset class. I mean, rarely you see gold, Bitcoin, equities, bond, commodities, everything in a sense has moved up in a synchronized manner. Why is that? I mean, financial markets are all about mean reversion. Asset classes never go up together. But it's been a good year for US equities, decent year for startup, great year for Bitcoin, gold has hit a new high, and bond yields have also rallied.
Yeah, I mean, it's really surprising. Even, I mean, it doesn't really make sense because, if you think that risky sort of, people where people hide, like gold has gone up, Bitcoin, which is a risky asset, also has gone up at the same time. And I mean, you can understand what's happening in India, but globally, why these asset classes are moving up and it's not even that we have interest rates which have high liquidity, where people would leverage and then come into the market. It's not even that. I guess, people have a lot of money, and, people made a lot of money after COVID. and they're looking for avenues to invest. And even after this run up, many are sitting on a significant amount of cash. So I think even now the liquidity isn't completely exhausted. So I guess it's just the money which was probably printed during the COVID times is something which is still making rounds around.
But Samit, how long do you think, this money in India equities, and now let's get back to the, motherland. How long do you think money is going to, continue to chase markets like India? And is there merit in now taking those tactical calls? Let's get stock specific, or would you say that you're better off taking those larger market cap agnostic calls as well? Because many believe that it's getting a little frothy now for small and mid caps, ease out from there a little bit, allocate higher bunch to large caps.
Yeah, I mean, see, if you forget the stock market, I think, and just look at the economy or corporate India, there is no frothiness in the economy. I mean, just look at the operating cash flow to sort of the capex ratio. It's at 2-decade high at 2 times. That means companies are making so much operating cash flow compared to what they're investing. Even operating cash flow to depreciation is really low. That means, I mean, capex to depreciation is very low. So which means not too much capex is happening. Generally at the peak of the cycle, private capex peaks up, and companies go for, the optimism is so high that companies go for even the low quality investment projects. And then they also compromise on the working capital cycle. Working capital cycle expands, and also they loosen the credit terms. So none of that is what is observed. I mean, if you see, it's actually opposite of that. We have the lowest working capital days across industries. The credit terms are very tight. And as I said, the ratios of capex are near the lowest. But in the recent times, if you see last 2 years, the state government and the central government, they had capex growth. I mean, they contributed to the overall capex picking up by 20% and 25%, respectively, in FY23 and FY24. Right. So that's a good sign. Now, after a long time, private capex has started. So last 12 months, the private capex is up 17%. Right? So these are pretty large numbers that, government spending 20-25% year on year, and then private capex picking up 17%. Even if you see the approvals in the banking system, mainly for new projects, it's at all-time highs. From year on year, the growth has been about 70% plus, and even in terms of number of projects, it's 30-35% plus. So these are signs which will result in growth. These are precursors to the actual growth coming through. Indian markets haven't grown significantly in the last 9 years. The earnings growth has been in single digits. It's been below 10%, and because of a lot of issues that we have had in terms of banking, excesses, 3-4 years back, we had the GST rollouts, we had COVID, all of that. So I won't be surprised if the next 9 years, we may make up for that, because our average growth rate is about 12-13%. So we may make up for that growth over the next 9 years. And if that happens, I'm sure, the money flow can keep on continuing to come into India. And one more, I think, real difference that we need to note is that even though the earnings growth in the last 9 years was just 9%, the operating cash flow growth over the last 9 years was about 15-16%. That's pretty high. 15-16% for India operating cash flow is pretty high, and that was actually the returns of the market. So market returns aren't too divergent from the the cash flows that corporate India has delivered, and we are sitting on one of the best balance sheets, even within India, and also I think across the world. Even when you look at the government, the corporate India, and then look at the tax collection, and government is going all out in spending on projects which will deliver. It takes time. There will be a lag effect, but the kind of investments which are going into India will definitely attract a lot more investors going forward. And I won't be surprised if FIIs go into FOMO mode because they've stayed out so long, and then India's is sort of a scarcity asset. There is very little growth happening in the world, and at certain point, FIs have the lowest sort of holdings in India in terms of percentage ownership in India. Just 16-17%. At highs, it used to be 21%. Right, so that 4-5% difference, if they try to come back, it's buying off almost $200 billion, and $200 billion, I don't think Indian markets can absorb. So let's see what happens, but I think the fundamentals are pretty strong.
But, Samit, the point is, what with this fresh money or money which is already circulating in the market actually chase? Because India traditionally has always been a stock-specific market. Now, of course, there are these larger umbrella macro calls which are being taken, bet on infrastructure, bet on the Make in India theme. What is looking attractive? And also, more importantly, because valuations have run up. These are all discovered pockets we're talking about in the market right now.
Yeah, I mean, that's been a big issue in India. It's the valuation. Valuations in small mid caps are 20 to 30% higher than the last 10-year average. In the large caps, maybe 10% higher than the last 10-year average. I'm talking about the median valuations, not the consolidated Nifty P multiple. So that's an issue, and I think the worst thing about this market is that the less work you do and the faster money you put into the market without doing real research, the more money you make. And if you waste time in doing real in-depth work, you lose out. The opportunity cost is pretty high, and in such markets, it's easy for investors to sort of compromise on the quality of work that you would do, and hence the quality of companies in which you invest may also be poorer. So I think that's something that one needs to be very, very careful. I will give you an example. I mean, there's no question that things are improving on the PSU side, right? But if you look at the last 1.5 years, the PSU pocket, if you look at just the BSE 500, there are about say 80-90 PSU companies. That pocket has gone up by 80%, and the rest of non-PSU pocket has gone up by 32%. Right? This is median return. But if you look at the operating cash flow in the PSU bucket, it's gone up by 0. And the operating cash flow in the private side or the non-PSU side has gone up by about 29%. So pretty consistent with what kind of returns it has generated. And so I think there are certain pockets. So wherever there is herd mentality, renewables, defense, shipping, railways, power, there are so many of these pockets where you can see stocks have multiplied in the last 1.5 years. Right? So one needs to be, cognizant of the fact that if the returns are too divergent from the fundamental sort of growth in the companies, then you need to be careful. There will be certain winners even in the PSUs, no question about it. But there would be more, many more failures. So in the long run, not many will be ending up making overall money. As a universe, if you are a really good stock picker within that, you surely will make money. Similarly, so there are a lot of pockets which are in the sort of non-fancied segments. So whether you look at, I mean, I'm positive on themes like anything which is going to help build India. So build India can be building real estate, it can be building warehouses, factories, it can be infrastructure, anything. But if you focus on companies where there are huge barriers to entries, any material supplier where there are huge barriers to entry, competition won't be coming in. I think next 4, 5, 6 years, of huge capex that India will go through, these companies will be the biggest beneficiaries. If there are pockets where a lot of new companies would be formed, then that would be spread across, and each company may not be making that much probably profits or growth in profits. So there are a lot of such pockets, whether it's in real estate, whether it's in building material, whether it's in sort of financing, especially NBFCs. which haven't done anything great. So I think so far it's been like the worst time for a good stock picker, because you don't get time to do your work. But I think slowly and hopefully slowly we'll move into, that kind of a phase.
Uh, why have you bought into NBFC, especially power finance and home finance? I mean, these are also crowded trades, aren't they?
Right. I think now they are becoming crowded trades. I think in this market, we invested probably maybe less than a year back. Stocks have more than doubled. What we thought will happen in the next 2 or 3 years happens in matter of months, and that's the problem. That even if we were late by a few months, you would have lost on. So we are careful in terms of picking these pockets. So what we look for is always earnings doubling in next 3 to 4 years. And for that, generally the return on equity has to be, higher than 18%. And there are very few in especially the NBFC space which meet that kind of a requirement. And we found that in the power finance kind of a segment. And the growth came through and the biggest change was the improvement in the balance sheet. What provisioning they took over the last 3 4 years, a lot of them, were coming back. Their market opportunity also expanded because beyond power finance, they also can now finance one third of their book into non-power projects. And then you also have a more, big fillip in kind of renewable expenditure, that we would be doing over. So there were demand triggers, there were balance sheet improvement. I mean, from a 4% net NPA, it dropped to 1%, and from there it would probably go to zero in this time. So there are a lot of triggers for it to sort of give you comfort on returns. And the valuation range, historically has been 0.6 times to say 3.5 times, historically. But, just a year ago, it was trading at the lowest end of valuation. So one has to be, choosy. And if you wait for the right pockets, there are opportunities. And, that's what we try to do.
Samit, morning. Wanted to get in your perspective as well as to what perhaps the big concern could be for the markets. Do you think that largely it'll emanate from global growth concerns versus any problems domestically?
Right now, I mean, the problem that I see is mostly global in nature, because globally, I think in terms of geopolitics, there are a lot of moving parts. In terms of trade barriers, there are a lot of moving parts. You don't know, next in the next year's election in the US, who would be the next president, and depending on that, the complete dynamics is changing. There is almost like a cold war going on. There are factions developing. Those can create a lot of friction in the global chain. My expectation is that India will be the net beneficiary out of this. So um, I don't know whether China plus one, those kind of things have really played out, but for sure, overall, the way India's competitors, are shaping up. Look at Vietnam, look at China, look at Bangladesh. India is definitely standing out. India's resilience was tested post-COVID, and so I think if something completely out of the blue, which we are not aware of, comes out, that would be the biggest risk. I don't really see something which is highly probable. And generally risks are such that you can't predict those risks. Risks which are predictable are generally priced into the market, and risks which we probably don't know are something which will shock us. And we just need to be ready, and you need to position your portfolio so that it can withstand those kind of crisis. If something goes wrong in the election, politically something goes wrong, if there is a war scenario, if there is some other pandemic which develops, one needs to be a little more comfortable in terms of what holdings you have. One sort of black swan event should not just destroy the profitability of the business or destroy the opportunity for your company.
All right, good to have you on board. Thanks so much for taking time out, Samit, and sharing with us your outlook on the markets. A quick check-in as to what the index is currently up to at around 20,884, and with the broader markets looking a little bit quiet. But we've got the newest edition then of CEO at Work. Nikunj caught up with the CEO of Lodha Group, that's Abhishek Lodha, talking about the booming real estate sector in the country and what they're doing differently to remain the favorite realtors in Mumbai. Listen in.
I think, this idea that the cycle has some kind of predefined length is not a factual situation. We had a very tough period for housing, and the factors for that are understandable, and that was between 13 and 20. I think what we are witnessing right now is year 3 of a much longer cycle in our view. Maybe it's 15 years, maybe it's even longer than that. Because India is going through what transition is happening as a once in a lifetime of our nation, which is we are moving from a low income country to a mid income country. And as that happens, a huge number of households, which have historically never been home ownership capable, will become home ownership capable. And as that happens, the demand will continue to scale up and the supply will struggle to keep up. This happened in the US from the end of the Second World War to the mid-1960s. It happened in China from the mid-90s to the middle of the last decade. And it happened in many, many other geographies where housing causes the creation of the middle class and housing benefits immensely from the creation of the middle class. So this is the sector which will drive our economy for the next 15 years. I feel quite confident this is a very long cycle, unlike the typical cycle, cyclical nature, which may be some people say 5 to 7 years, you mentioned 7 to 10 years, but whatever that may be.
So one is demand. Demand remains strong, which is, a builder is in a good spot because demand is strong and your units which you're selling it sells. Second is price appreciation. Are we in for both?
Yes, I think the reality of the fact is that 50% of Indians have 50% of the wealth of Indian households is in housing. Yes. And you saw the impact of house prices falling or remaining flat in the period from 17 to 20. And that affected the entire economy because consumption goes down, confidence goes down. So what we would love to see is that home prices rise around or just below wage growth, so that affordability keeps improving, but at the same time, people who own homes feel richer. I mean, I'll give you a statistic and it's quite stunning. A family which would buy a home today, 50 lakh rupee home today, that home would be worth 3.5 crores in 2047. So when our Honorable Prime Minister says that 2047 is the year India becomes kind of a developed nation, you can imagine that for a middle class household to feel 3 crore rupees richer only because of their house, then everything else that they earn can be used for other purposes. So the home is a huge creator of wealth for the middle class or anybody who owns a home. And therefore, it's very, very important that home prices go up. They have to go up modestly, but they have to go up.
But so we've addressed the big picture, which everybody wants to know from India's biggest real estate developer, residential real estate developer, outlook on cycle and outlook on prices. Now let's focus on shareholders. The shareholders are also happy lot. Post-COVID, magical things have happened to the real estate stocks and your stock also. What has changed post-COVID for you?
I think I can't comment about anything about pre-COVID and what happened to stocks pre-COVID because we were not a listed company.
No, I'm generally saying for your group per se, you just cut out and you're just going from strength to strength post-COVID.
Yeah. What's happened is a culmination of a lot of pain that the sector went through between 2012 and 2020. We had very good regulations like RERA. We had other things like demonetization, GST, the insolvency and bankruptcy code affecting the sector. We also had a large number of the non-banking financial companies, which you cover closely, who took large real estate exposures, lent to developers who were not meant to be in this business at the scale that they were being lent to, and that created oversupply. When IL&FS imploded at the end of 2018, the correction process started then, not because of COVID. And now you have a situation where consumers are aware that they should only buy from the best brands. They want quality. They also want certainty and trust. And that in turn has led to the situation where you see that the stock prices of the top developers are doing well because the people or stock investors realize that not only is India going from low income to mid income, not only is the quantum of housing demand huge, unlikely to be met anytime soon, but also that the consumer preference has dramatically shifted to very, very select brands or players. And just like in any branded business, you will have those players getting the majority of the demand and therefore the profitability.
Lodha has bulk of its land bank and also future projects in Mumbai. Some would say that that is concentration, but is that a conscious strategy?
We definitely have overweight on Mumbai. Mumbai is India's deepest housing market. It is India's largest housing market. It has everything from homes from 30 lakhs to 300 crores and everything in between. We do not like concentration, and therefore even in Mumbai last year we had a total of we totally had 30 operating projects last year, 25ish of them in Mumbai. So yes, we are overweight on Mumbai. We very much like being Mumbai's largest real estate player and being able to serve all the segments in this city. We are expanding now into Pune. We have 5 projects now in Pune. We have one project already launched in Bangalore earlier this year, which did in November, which did very, very well. The launch was very successful. We'll have one more project launching in Bangalore in the next 4 to 6 months. So we are broadening our base, but absolutely we are very happy and very proud of the fact that we are Mumbai's leading developer and therefore are able to shape the future of India's financial capital and India's biggest housing market.
You've gone on record and you've said that we are not a real estate company, we are an FMCG company. You've started thinking like this. You're consciously looking at reducing your debt. You're consciously thinking design. Real estate builders earlier were thinking differently, but you are thinking in terms of FMCG and design. What does that mean?
I think, it's a consumer good. It's not fast moving. So I will put it in the consumer goods category. I think our business model is set up to land as a raw material, produce what the market needs, have reasonable appreciation for the product, but not be, price maximizers. And most importantly, understand the consumer and serve the entire spectrum of needs of the consumer, from the time they buy to the time they move in to how they live after. Means we completed the World Task several years ago, but even today we manage all the facilities and amenities because we want to make sure that the experience does not deteriorate. And that really is our mindset. In terms of our business model, we are a very people-centric organization. We focus on building deep talent pools. We're very decentralized and empowered in our way of operations. And you can see that is a way of working that any good quality company in any sector would work. So yes, we think about ourselves as a consumer goods company and our product is housing.
Let's look at the debt. The favorite question for all television anchors when we meet real estate companies. You've consciously reduced your debt. Net debt to equity is less than 1 now.
Less than 0.5 now.
Yeah, I mean less than half now. And if this current run rate continues, FY24 technically you will be net debt free.
Yeah, I think if we were wish to, we could become a net cash company over the next 2.5 years. So not FY24. FY24 will literally end in 4 months, so we will not become net cash in that period. But yes, in a short duration thereafter. We are very conscious of being very conservative on our leverage. We think the opportunity is very long, but there can always be black swan events. There can be other things which can go wrong for a short period of time. And as an organization, we want to be growing and scaling up in the most risk-free manner or lowest risk manner. And in that, having very low leverage is very, very important for us. So we are very conscious that we want to continuously and always keep debt below 0.5 times equity and below 1x of operating cash flow. And in the good part of the cycle, we want to be even lower than that, so that in a tough part of the cycle, if we have to come up, we'll come up to that level.
But if you're confident that this cycle is a long cycle, you have a brand, and even if you, let's say, keep your debt to equity ratio to 2 or 2.5, it's fairly acceptable, but that will also give you a lot of growth runway.
It could, but we are of the view that we can, keeping our balance sheet very, very conservative, we can grow at 20%, our pre-sales and top line at 20% and deliver 20% ROE. I think if our internal cash flow generations are that strong that we can sustain our 20% growth, then there is no reason for us to add on risk.
In terms of the concentration, what builders have, you are a Bombay-based real estate company. Prestige is a Bangalore-based real estate company. DLF is a Delhi-based real estate company. Is that the differentiating factor now for all real estate companies that grow in the areas where you have the core market?
I think everybody needs a core market. There are probably 3, 4, 5 players in the country right now who are of scale, have a brand where consumers are aware of. Some brands are much more valued and sought after, others may not be as much, but broadly there are a very handful of real estate companies in our sector, like in any large sector, where the brands are strong enough to scale up. And everybody has a core market, a home market. Ours is Mumbai, and these brands, some of these brands will travel well, as we saw with our launch in Bangalore, where we were sold out in less than 72 hours of the first launch that we did. Others will travel less well. So I think the operating models of different companies will differ based on the depth of their management capability and the strength of their brand.
Now you guided for pre-sales and 2 quarters, you've achieved 48% of that. The second half, this time we've had Diwali Dussehra, and the second half traditionally is a better half. So can I safely assume that if I put data point, you're on course not only to meet your guidance, but to beat your guidance?
I would say is that the 20% growth that we promised last year, we of course promised it being taking into account what we felt the year was going to be like. It looks like the year is on track to meet that guidance.
Is there a volume growth advantage which you have in that 20%?
Yes, of course. Like I said, we like to keep price growth modest, not low and not very high. We like to keep price growth a little below wage growth. So this year, wage growth in the country is going to be around 9%. We are targeting price growth of between 6 to 8%. And therefore, the rest of it is all going to be volume. So we are growing our volumes by about 13-14% this year, partly from existing locations and partly from new locations.
This is 2023. Third quarter of FY24. Hypothetically, if you're having the same conversation at the same place, apart from more Lodha towers, what else do you think we are likely to be discussing in terms of size, in terms of where you think you would have reached? 5 years.
I think, scaling up and sizing is one part of the journey. We, of course, are very committed to, continuing to scale up in a predictable manner, in a low risk and predictable manner, which I think differentiates our business from some of the others who may be in this industry. But I think beyond that, I think our commitment to being a purpose-led organization which gives back to society and makes a positive difference to society, not just in the jobs that we create or the great ecosystems that we have for people to live or work in, but also how we use our capabilities, how we use our intellect to make an impact on society beyond just the business that we do, is a very important part of what we exist for. And I think you will see that, some of the initiatives that we are taking will make a bigger impact on society in these next 5 years. So perhaps you'll spend a little bit more time discussing those too.
Fantastic. Now, there's a time when real estate stocks, in a sense, had a very ugly reputation. They were considered to be the ugly ducklings. But a lot of things have changed now. What to your mind has led to the change? And when I speak to Lodha, when I speak to Prestige, when I speak to DLF, every real estate company is very debt conscious. They're talking about growth and taking predictable risk. What changed? ऐसा क्या हो गया?
See, you can look at the real estate stock performance pre-Lodha's listing and post-Lodha's listing.
So you've got the corporate governance standard back.
I don't know what we've done, but I think we've been very clear in what we want to be. We, like I said, predictable, low risk, focused on the highest standards of governance and focused on the highest standards of ESG. We are on track to not only be net zero on our carbon emissions in 2024 on scope 1 and scope 2. We promised we'll get there in 2035. We're getting there in 2024. But really, across the board, and I can get into more detail on that if that's of interest to you. But we truly believe what we brought to the table is a organization which is in the real estate space. People have not seen an organization thinking and acting in this manner. And I think that's what I'm thankful to our shareholders for their initial trust. And I hope that we have kept up that. And our peers and competitors are very smart. They have also seen what is valued in the marketplace, and I think some of them have also started following, which is great for the industry, because if the top 4-5 players start acting in this kind of consistent way, deliver great growth, predictable growth, great product, and at the same time improve governance and lower risk, then why should this industry not be valued in the manner that any really well-organized, well-run industry is valued?
I can see families have already moved in. So what's the current occupancy in some of your big projects?
Occupancy across the board tends to be very high because most people after 2014, most of the sales have been for end users, and therefore occupancy levels tend to be very, very high. Depending, I think once you're about 18 months into completion of a particular building, you hit occupancy levels which are, high 90s, mid to high 90s.
Okay. Now I'm going to ask a question perhaps on behalf of our viewers and your shareholders. Everyone has a different time frame when they're investing in a company. So in 3 years, what they should expect from you, in 5 years, what they should expect from you, and beyond that, I think we'll discuss the next time.
No, I think short term, medium term, which is the 3 and 5 year sort of timeline that you mentioned. I think what you can expect from us is predictable, low risk, 20% growth in our top line and 20% ROE.
That you can do on this large base also.
Yes.
And keeping the debt to equity under one.
Means our ceiling that we've set for ourselves is 0.5 times.
Good to have you back with us. Let's identify then some movers in today's trading session, and the mid-cap index is sort of trying to pick up steam as it continues to remain rather range-bound. You've got something like a KPIT Tech up 5%, REC is active, HPCL, Trent, Motilal Oswal Financial, Vodafone Idea, by the way, up 3%, and then there's Chalet Hotels as well that makes it to the winners list. Lots to talk about as well when we discuss things in the primary market. Inox India's IPO, what are their capex utilization plans, what are their capacity expansion plans, demand growth. We've got Siddharth Jain, the promoter and non-executive chairman of Inox India, now joining in. Thank you so much for taking time out. Good to chat with you about a different business arena. Siddharth, Avan this side. Let's start off with the basics and just help our viewers understand a little bit more about the business. What are going to be the focus areas? What are the use cases for the products?
Avan, good to see you. Good morning. Thank you for having me on your show. Yes, today is a different avatar indeed. This company, Inox India, was founded about 30 years ago in 1992 by my father. It basically deals with manufacturing capital goods in the cryogenic space. Not many people understand what cryogenics are. It's handling fluids that are colder than minus 100 degrees centigrade till minus 270 degrees centigrade. So we are one of the world's leading players in manufacturing customized cryogenic solutions. And our end markets are primarily in the clean energy space. That's where the growth vectors come from, where the end use applications are in liquid hydrogen, LNG, all the regular industrial gases like liquid oxygen, nitrogen, and also another division called the cryoscientific division, where we do a lot of work for ISRO, global space and space research and global scientific projects.
Morning, Siddharth. Nikunj also joining in. I still relate with that whole Inox image every time I interact with you. So I'm going to use that movie terminology. Inox India, in a sense, is like the Bahubali of the sector, right? Great margins, solid moat, very big in terms of skill. You don't need money. You can have easily raise working capital. You can easily go to the market, float a debt. Why are you going public?
So, glad you asked that question. We've been around for 30 years. We've developed a great brand name in India for sure. We are market leaders in India, the largest players in India, both domestically and we largest exporters from India. What we really want to do is go and capture a larger chunk of the global market. And when you want to, the product that we make is a capex product. It's not something that's used in OPEX. So when we go to some of the world's largest oil and gas players and the industrial gas players, visibility is something which is very critical. And being a publicly listed player, a lot of my peers that I compete with on a global basis, they're all publicly listed. And they have manufacturing in multiple jurisdictions, multiple continents. Currently, we have only 3 manufacturing facilities in India. And we certainly hope to grow that in the future.
You're raising money for capex expansion, can I assume that?
No, this is 100% OFS. We are a debt-free company. We have over 220 crores cash on the balance sheet. So the primary objective is, in the clean energy space, we really don't know which way this is going to expand. two of our largest growth vectors, as I mentioned earlier, is in the we make equipment for storage, transportation, and redistribution of things like green hydrogen, ammonia, LNG. When you look at those markets and what's going to happen there, we've seen that, especially in the clean energy space, we've seen the West take a lead. We've seen parts of Asia like Japan, Korea take a lead in making large capex investments. So we feel we want to go and tap on opportunities in the rest of the world. And with the strong foundation that we have built in India, with our, we are one of the lowest cost manufacturers of cryogenic equipment. We have one of the strongest engineering teams with over 400 engineers. We specialize in customized solutions. So now that we've built this really strong foundation, we really need to go to the rest of the world and go and tap on much larger players. And when they, dealing with an unlisted Indian company is slightly different to dealing with a publicly listed company with a good reputation.
When you will jump into the global arena, which are the companies you would be competing with? How efficient would you be there? Because at a global level, you'll have to compete with the Chinese counterparts, you'll have to deal with the local counterparts. How will you stand out?
So, as I mentioned earlier, we are already one of the lowest cost producers in the world. We have exported to 60 plus countries. 45% of our revenue is in exports already. Now that has grown over a period of time. A couple of years ago, we were at 30% of exports. Today, we are at 45%. We hope to see that growing. So we've been competing with our global peers for a long time. And where we stand out is our ability to give customized solutions to our global customers. When you look at, the oil and gas players, a person who's setting up, let's say, a liquid hydrogen plant, like in South Korea, they're setting up the world's largest liquid hydrogen plant right now. They selected us, Inox CBA, a made in India product, to supply their baseload liquid hydrogen tank storage there. Now, that's a matter of pride, not only for us, but for our country, that we've been selected to supply the world's largest liquid hydrogen plant. Similarly, there are various LNG applications. We supply to every corner of Earth. Our tanks are in Alaska, Australia, from Chile to South Korea. So we are proud of the fact that we make a world-class product. Now we just need to go out there and make sure we're in front of all our global customers.
Income growth, CAGR growth 27% last 3 years, PAT growth 26%. Any reason for me to believe that the future will be different from past?
Well, I do hope it will be, not only the same, but better. We certainly hope to outperform. It's a function of our end market. As I said, a lot of the products we make of the clean energy space and the pace at which that sector is growing is certainly, holds me to believe that we can grow at a better pace. Fingers crossed.
Inox, we used to look at movie, the content library, we used to look at footfalls to understand that what will happen to multiplex as a business. What are the indicators we should look at? Because yours is a industrial, a B2B driven business. What are the levers one should look at, the triggers one should look at to understand that which way the growth trajectory is headed?
So, we have 3 divisions in our company. The first division is industrial gases. The second one is LNG, and the third one is cryoscientific. Industrial gases has traditionally grown at 2 times GDP. 2 times GDP of the country in which you are active. So let's say, we are a large player in India, and if India is growing at 7% per year, traditionally the industrial gas market would grow at 14% a year. LNG, it has a low base effect because currently it is a supply constrained market. As we have more and more LNG terminals come up in India, as we have more LNG supply all over the world, we're going to see a dramatic increase in the requirement of infrastructure to move that LNG. So when we come in, we are not in the liquefaction process of making the LNG. We make product for the storage, transportation, and distribution to sell that product on a global basis. So the more molecules of LNG that are available on a global basis is directly proportional to the potential for us to grow our business. And coming to the cryocyclic piece, we are connected to, for ISRO, for example, we've been partners with ISRO for more than 20 years now. In fact, the launch pad in Sriharikota, launch pad 2 from where Chandrayaan 3 and all the rockets were launched, we played a major role in the early 2000s in building that entire launch pad. And since then, we've partnered with ISRO to make many more products for them. So when it comes to the global space and space research, we export to global space companies as well. So it's difficult to give you a metric, for that. It's not connected to per launch. It's connected to creating the infrastructure for the launch pads. That's where, we play a role.
If somebody is looking at participating in the IPO and what is an OFS for you, how should one look at Inox India? Is it a play on manufacturing? Is it a play on a engineering company which is going to be moving into clean energy, into space? Or it is a pure play on an engineering marvel where there are 3 verticals, it could be 4, it could be 5. How should one look at the big picture here?
I think you very nicely put it. I would say all of the above. Combine everything together. But no, the core is, we have our own IP. We design in India. We engineer our products in India. We engineer to global standards. We make pressure vessels. So when you make pressure vessel and you have to export them to different countries, every country has a different pressure vessel code. And we have to understand that code. Our shop has to be certified by the pressure vessel organizations, the government organizations of those countries. So we've had innumerable visits from foreigners, from various pressure vessel departments of different countries come and actually physically certify our shop. And after that, you have to consistently manufacture, a low cost, great quality product, because once our customer buys our product, it's there for the next 20 to 30 years. And failure is not an option because they are mission critical. We supply to, just as an example, we are major suppliers on behalf of India to a project called the ITER project. It's a global nuclear fusion project that's happening in France, where 7 countries have come together to put together this $20 billion project. And they're basically recreating the sun in its physical form on Earth. Now, you can imagine the criticality of the equipment there. You certainly cannot afford a failure if you're recreating the sun on Earth. And we've been selected as one of the few companies in India to supply extremely critical equipment. These are liquid helium multi-process pipelines for the main tokamak. Now, it took us about, I think it was 2 to 3 years of work to get selected for this project. So, to answer your point, how should investors look at it? There is a lot of IP, there are a lot of barriers to entry. Developing a name and reputation takes a very long period of time. We've been in this business for 30 years. So, and another reason for the IPO is a coming of age for us.
Self-invite myself to understand that what really goes behind the scene. I mean, it's just sounding so fascinating, the kind of, progress India is doing and the kind of work you do in clean energy and in the space of engineering. So I'm going to self-invite myself, hopefully next time when we meet at your units.
It will be a pleasure to host you and all your colleagues at our factory. We are based in Gujarat. We have 3 facilities right now with a 4th one underway as well. And we'd love to show you what we're doing and what India is doing.
Good luck with the IPO and thank you very much for joining us.
Thank you.
Okay, let's move on. Let's just take stock of what the market as well has settled in at. Was pegged to be a quiet start and it continues to really, hover around sub that 20,850 mark in trade. What's under pressure? Balrampur Chini down 2.5%. Syngene Z, PI Industries, by the way, is down 2% and Laurus Labs 2 down 3.25%. But the biggest voices of India Inc. descended and converged at the Economic Times Awards jury event, and at the CEO roundtable, they spoke and discussed matters related to Indian growth. The Tata Sons chairman N. Chandrasekharan spoke on how India is witnessing an upside in advanced manufacturing and what he believes is the biggest differentiator for any economy. Meanwhile, Uday Kotak spoke about why he expects volatile interest rates in the near future.
You know, every time I look at India, I really am amazed by the potential we have. But along with the amazement, there is a restlessness about how soon we can really come up to potential. Because though we have come a long way, I think we still have much to achieve. And if you are looking at my industry, of course, you know, the overwhelming pace of technology evolution is something that it's very difficult to internalize and understand how quickly things are changing and how much we need to sort of, speed up in order to keep up. And especially where Indian industry is concerned, I think there is a lot that they need to leapfrog to. Having said that, if you ask me what I most worry about or what I think is a very big priority, for me, there is only one word that can answer most of our problems, and that's education. And there I would say skilling is the need of the hour. While we have huge number of very talented people, but they still need to be skilled in the right way. I think, that's something that's a priority, and that's what I worry about.
I think first on your question about our industry, which is the banking and financial services industry, the key question in our minds is who's going to win, Arthur Bunds or Paul Walker? And that's the big question around the world. Which way is inflation going to go? You sleep at night, you feel inflation is coming down. You wake up in the morning, it feels like it's going up. And at this stage, fog chal raha hai ki inflation kam ho raha hai. Who knows what's it going to be next week? So that is one big thing out there which will drive global inflation, global interest rates, global growth. The second one in our industry is how fast are we disrupting ourselves? If we don't, customers will make sure we are out of business. We better get our act together and fast as we can. These are the two things in our industry. On the broader India scale, I think there are three important points which I think India really needs to strategically take forward, and we need to think about it deeper. One, we have the heft on the global scene. We've reached scale and size, but we need to, for anyone to be a sustainable power, it has to be disproportionately powerful militarily and defense. And India is spending a hell of a lot of less money compared to what it needs to do on the defense side. True power comes first and foremost of all from military power. So I think we need some ways to go that, and that will mean significant budget spending. Second important point in that context is the world's pretty clear that the planet Earth is in trouble faster than we are able to sort out our differences. And therefore, sustainability is going to be the big agenda for business opportunity and for finding ways of gap funding to save planet Earth. That is going to be a big priority, and India will not be able to say, oh, our developed countries have sort of used the planet so long, and therefore we don't have the luxury of time. And the third one is for India. For all the wonderful things we are doing, we need to get our trade competitiveness up. At $100 billion negative trade deficit with China, we have our work cut out. So if we get these three things as a focus for India, I think it's clearly the next 25 years belonging to India.
I just want to make a few points on why the fundamentals are in place and what are the trends and why India is well positioned in that environment. The last decade, I think, we have gotten a lot of things solved. We have a very strong policy environment, and our banking system is very, very strong today. I think very stable, well managed. Corporate balance sheets have been delivered by and large. And even the mood in the country is very, very positive. Consumption is going up. So all the data points indicate that you've got a very solid base from here to take off. To my mind, there are 4 trends. The first one is, you call it digital or artificial intelligence or whatever. By far, India probably has the best digital public infrastructure. And we have leveraged this digital public infrastructure and have done national programs of mass scale, which you cannot find too many examples around the globe. So this backbone will play out in creating new business models. There will be more startups and also more delivery models even in established companies.